All right, well, let's end by looking at a red hot trend this year, and that's IPOs. Check out Renaissance Capital's IPO ETF, up 32% this year, almost double the gains of the S&P 500. This as Wall Street obsesses over WeWork's debut as heavy hitters Uber and Lyft sink to all-time lows. With more high-profile IPOs straight ahead, let's check in with Kathleen Smith, chairman and co-founder of Renaissance Capital, for her expertise. Joining us on the desk, Kathy, it's great to see you. We know the ETF. Help remind our audience what your ETF sort of encompasses.
It's a basket of a 2-year rolling population of newly public companies, and it's weighted by market cap, so it owns the largest, most liquid IPOs that have been done over the last 2 years. It has a quarterly rebalance, but also a fast entry if there's a very large IPO. So it's the only ETF in the marketplace that has pure exposure to newly public companies.
Now we have Smile Direct Club, Peloton, WeWork, all on deck in the next couple of weeks. How are you kind of looking at these new names coming to market?
Well, the ETF will include the larger, more liquid names, those you've mentioned, and we're looking at it from a buy side. So we're hoping that the valuations are much more reasonable than the way they valued Uber and Lyft. And I think Uber and Lyft's poor trading is going to be a big advantage to the buy-side investors when we address WeWork, Smile Direct. All of these companies are going to have to please a pretty nervous set of investors who already got burnt in some of these large money-losing IPOs.
Well, because importantly, you guys are buying these IPOs after they're publicly traded. You're not getting big allocations because you're a friend or a family member. And that means you want them to be priced, at least accurately and maybe a little low for their actual opportunities. And that's what generates the performance your fund's so well known for.
Well, and we do. And so the beauty is that even though Uber became a top 10 holding in our product, we've had some very strong names. I mean, Roku is the second largest holding in our product right now. And it's interesting to see how it works because on Roku, it's a 7% holding in the ETF. And I looked at all other ETFs and who has the largest holding. It's our IPO ETF. The second largest holding is less than 2% of another ETF in the market. So we are getting exposure for investors to these very new names that are not included in other or underweighted in many other indices.
I'd like to get your perspective on WeWork because it has garnered a lot of criticism and it hasn't even gone public yet. It's raised $12 billion since it launched, but has yet to turn a profit. What do you make of the name?
Well, it's hard not to think about Uber when you think about WeWork. We've studied IPOs all through history, and the most money-losing IPO ever in the 12 months leading to its IPO was Uber. The second one is WeWork. The third one is Lyft. If you look at the performance of those IPOs, they do not do well for investors. It's going to be incumbent upon WeWork, and for many reasons, to get that valuation low. On valuation, for example, there's a perfect peer trading in the market. And if you valued WeWork like that peer, instead of being its $47 billion private valuation, it'd have a $20 billion valuation. So we'll see how this goes. I think it's important. An interesting, disruptive company, but it has to be valued correctly.
So they may be loss-making, Steve, but is it still a good sign that more companies are going public amidst this broader volatility in the market?
I've been in the market since 1993, and I've heard that be a great sign, and I've heard everyone say it's the top of the market. So it depends on which glass you're looking through. But when you see the majority of these IPOs are well-priced and perform well after the fact, you do get a little push and pull. So hopefully the minority of them have an issue in 30 days, 60 days, 90 days out. Obviously the lockups, when you play individual names, always know when the lockup expires.
Sure.
That's the death nail to a lot of these companies short term.
Could see increased selling around
Correct.
those times. Kathleen, finally, we hear a lot of people compare this market to a dot-com bubble, loss-making companies tied to excessive valuations. I mean, do you see truth to that analogy?
There's a little bit of a rhyme to the internet bubble, but not even close on a few metrics. I think probably the most important one is if you look at the average age of an IPO coming out now, it's about 10 years. Back in the 99-2000, we saw companies that weren't even a year old. The excess was incredible. The numbers, the dollar volume, it was 2 to 3 times anything we're seeing now. So, and the retail investor. was in the market big time in 99, 2000. Now, individual investors and their advisors, they own ETFs. There is not a big retail component in the IPO market, meaning it's slightly more disciplined than it was back then when individual investors just, we'd be at a cocktail party and I was a popular person back then. Now, there's many other subjects, but it isn't about individual stocks. I'm sure you've all seen it.
Impressive to see that your ETF is up 32% because we tend to fixate on Uber and Lyft at all-time lows, but there's some names that have actually done pretty well.
It's absolutely been on fire. It's been a phenomenal market to be part of. I actually think this is a very healthy IPO market. You're always going to have a couple that come to market that are really overvalued. It really does come to that consistent, accurate valuations. You want IPOs to come out and move 1% or 2% on the day they come out. We've seen some of those, and then people learn those stocks. They run up, they show up in Kathleen's fund, and you get that kind of performance.
And then you look at Beyond Meat, best performing IPO this year. I mean, out of the park.
Yeah, it's crazy when you look at Beyond Meat, and you taste the product, it's a great product, but there's a social aspect that is 90% of the performance on Beyond Meat. And when you look at a company like Tyson that didn't perform well as of late, there's a lot of competition that could come on. So you have to be careful when you see these outsized gains and how long individual names can really extend those gains. And that's why it's always a safer bet to go into an exchange-traded fund where you have a little bit of the muting of the risk analysis.
Well, it's certainly an interesting part of the market. Kathleen, thanks for providing your perspective here. That's going to do for us on ETF Edge. I'm Seema Mody. Thank you to Kathleen, Dave, and Steve for joining us today.